This is Macro Horizons, episode 341, The Dueling Duel, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of September 15th. As the FOMC decision looms, we're reminded that the Fed is mandated to manage both inflation and employment. The obvious parallels with dueling banjos are difficult to ignore. Wonder if Richard Clarida ever recorded a cover. He should. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the Treasury market and the Fed got enough information to convincingly price in 25 basis points for the September 17th meeting, as well as a series of rate cuts in the meetings to come. The core CPI data was of note, and we saw, on an unrounded basis, during the month of August, core CPI printed at 0.346%. Now, when we break that down into the supercore measure, what we saw on core services ex rent and OER was an increase of 0.33% in August versus the 0.48% in July. Even core goods was up just 0.3%. On an unrounded basis, that is 0.276%. That means that tariff pass-through, while evident, has been relatively limited. And when we translate the CPI and PPI data into core PCE, that's currently running at a low 0.2, unrounded 0.18, which is very consistent with the Fed's 2% inflation target. So it's with this backdrop that we also saw the highest initial jobless claims print since October 2021. The weekly figure came in at 263,000 jobs. Now, it's important to keep in mind that this was for the week that included the Labor Day holiday, and historically, holiday weeks have seen a bit more volatility for the initial jobless claims figures than non-holiday weeks. Nonetheless, it was still a notable increase in jobless claims. In addition, we saw the preliminary revisions to the establishment survey, i.e. the benchmark revisions, which showed a decline of 911,000 jobs. All of this simply reinforces the fundamental backdrop that will allow the Fed to restart the process of normalization next week. We also saw solid auction takedowns, which takes off the table the risk of a buyer strike for treasuries. In fact, the way that the market has developed over the course of the last several months has really alleviated many of the supply concerns that had defined the first two quarters. And as a result, the Treasury market is, to a large extent, back to trading the classic fundamentals of growth, inflation, and monetary policy expectations. Putting this in the context of price action, we were encouraged to see 10-year yields trade below 4% in the wake of both the core CPI numbers as well as the increase in jobless claims. When we put this in the context of our expectations for the balance of the year, we're continuing to hold our 385 target for 10s, but we'll acknowledge that there is now more downside risk than there is upside risk from that target. We remain biased for a steeper curve and expect that the 2-year yield still has the capacity to decline further once the market begins the process of contemplating what happens if the Fed needs to do more than just normalize and instead needs to shift policy into truly accommodative territory. We have yet to see that priced into the futures market, but that is a discussion that we expect will be triggered by next week's FOMC events.
Well, ahead of the CPI report, it was fairly easy to characterize what happened in the run-up to the inflation data in the Treasury market this week, and it was, in a word, bullish. We got 10-year yields right up against 4%, just ahead of CPI, and in the wake of last week's jobs report that showed the highest unemployment rate since 2021, and just 22,000 jobs added in August, the willingness to buy treasuries has been readily apparent as yields across the curve have moved lower, the Fed is preparing to cut next week, and concerns on the state of the labor market and the broader economy are benefiting treasuries as an asset class. One of the most interesting aspects of the move, at least early in the week, was the fact that it was flattening in nature. And as an indication of the positional backdrop in the market at the moment, the fact that all it took to get the curve off the steeps was a softer than expected jobs report goes to show that there remains an underweight duration bias, and to get the curve meaningfully steeper from current levels, we're probably going to need to hear even more dovishness from the FOMC, and for that, we'll have to wait for next week's meeting.
It's also notable that the shift in the trajectory of the labor market, or at least the perception of the labor market, was truly the missing piece for a long-duration bias. The reality is that up until this point in the cycle, the labor market had demonstrated a remarkable amount of resilience. But now we have the combination of the last few months' worth of payrolls figures, as well as the preliminary benchmark revisions, which reduced payrolls by an average of 76,000 per month during the period between April 2024 and March 2025. So what this means in practical terms is during that period, monetary policy was more restrictive than the BLS data was indicating at the moment. Translating this to forward monetary policy expectations, it follows intuitively that it's time for the Fed to restart the process of normalization. We're anticipating a series of rate cuts to come. This is not a scenario in which the Fed is simply going to offer a few fine-tuning adjustments to monetary policy. Instead, we're anticipating that Powell will message a series of rate cuts to come, which will presumably include moves in September, October, December, as well as in Q1 of 2026. The biggest uncertainty at the moment is what is terminal on the downside. Should we expect monetary policy rates to get back to 3% and be held there indefinitely? That's what the futures market is suggesting at the moment. We'll argue that there's another leg of the bullish repricing yet to come, which will price in some non-zero probability that the Fed's bias will ultimately be accommodative, i.e. below neutral, at some point during 2026 or 2027. Once that sentiment takes hold, we anticipate that 2-year yields will reprice even lower, as opposed to being centered around that 350 level, as we've seen throughout much of the last couple weeks.
And from an even higher level, and away from what's going to come to pass in terms of monetary policy over the rest of this year, we'll argue that the benchmark revisions demonstrate precisely this idea, and something that was obviously frequently debated immediately in the aftermath of the pandemic, which is that R-star and the true level of neutral might be a little bit higher since COVID, but not significantly so. So policy rates at their current level, and the levels they've been at over the better part of the last 2 years, are still exerting restriction on the economy and still imparting a slowing impulse on the pace of hiring. Recall at some points over the last several months, there was a debate if Fed funds was restrictive at all. And so now that we have a clearer picture around how the pace of hiring has slowed in recent months, but also how the job market performed over the last 2 years, we now have a better answer and greater clarity around the uncertainty of the effectiveness of monetary policy in the post-pandemic economy. And by no means does this suggest that the Fed is at the precipice of cutting rates back to zero, but it also implies greater cutting capacity back to neutral or even into slightly accommodative territory than would have thought to have been the case as recently as a few months ago. So in terms of the range of potential outcomes from where 2-year yields can go from here, it introduces much more bullish potential, particularly in the front end of the curve, and probably a bit more steepening upside over the longer term.
In the spirit of taking a step back, it's also worth observing that a lot of concerns that were raised at the beginning of the year and really underpinned the bond bearish moments have been resolved and, frankly, in favor of lower yields. Chief among these concerns was the notion that everything occurring on the trade war side would translate into a buyer strike for U.S. Treasuries. Now, clearly, that has failed to emerge, and as we have seen, the auctions continue to go reasonably well, as evidenced by a record low dealer allocation at the September 10-year auction. This points to strong end-user demand that we expect will continue to offer solace to investors who were worried that the global community would take a step away from the Treasury market. And as you point out, Ben, we also now have confirmation that monetary policy still works. It still works with a lag. And while the post-pandemic economic reality might be slightly different than it was before 2020, the fact of the matter is that Treasury yields are back to a very familiar range. The Fed is about to embark on a rate-cutting campaign, and equities remain at record highs.
And to the point on auction takedown, both this month, but also more broadly, this represents a success for the new administration and Secretary Bessent specifically. Obviously, after the election, Treasury supply was high on the list of investors' worries, and the fact that the message from Washington has been clearly delivered that the Treasury Department wants long-end yields lower implies that a term premium-driven bear steepening solely on supply concerns is going to be unlikely in the near term. A record-high end-user takedown at a 10-year auction, even after the scale of the rally we saw to start this week, shows that even with historically large deficits, there's no shortage of demand for treasuries at these yield levels. Now, of course, this is also related to the fact that it's become clear the Fed is going to need to start bringing rates lower again, but also recall what we've seen in terms of economic data elsewhere. Canada comes to mind, and what we will probably see in the form of another rate cut from the BOC, as the global economy and the global labor market downshifts as a function of the realities of the economic cycle, and also the growth negative implications of Trump's tariffs, and what is generally expected to be a far dimmer growth outlook both domestically and globally. This is naturally going to moderate any potential hawkishness on the part of central banks around the world, and if the global interest rate complex is going to start to move lower more quickly, then 10-year yields north of 4%, not such a bad deal.
And we made the observation earlier that a downshift in the labor market was one of the missing components of this cycle that had been an anomaly, or at least a key point of interest over the last several quarters. We are now growing increasingly concerned that that will translate into a downshift in the pace of consumption. Recall that in Q1 and Q2, personal consumption was under pressure, but still in positive territory. What remains to be seen is whether or not uncertainty on the jobs front will translate into a more conservative consumer, as it were. The upcoming retail sales print will offer some context for the pace of consumption, although it's worth observing that the wealth effect has been a key contributor. Specifically, the upper quartile remains a key contributor to the overall pace of consumption in the U.S., and anecdotally at least, the bottom two quartiles have been struggling with higher prices and increased uncertainty on the jobs front.
And to circle back to what we mentioned earlier, in that the post-pandemic economy maybe is not so different than the pre-pandemic one, it's exactly this feedback loop that will ultimately drive what will inevitably be the end to this current cycle and a recession, even if it's not as severe as the financial crisis or COVID, a period of negative real growth driven by a true slowdown in consumption and spending that is ultimately a derivative of a labor market that takes a leg lower, wage growth that slows, and households simply having less to spend. To your point, Ian, the performance of assets means that the upper quartile may be able to delay or mitigate the severity of the downturn, but now, with more than 5 years since the pandemic began, it's become clear that higher policy rates are effective in bringing inflation lower and cooling the economy. Would the Fed hope to stop that cooling before a recession ultimately takes hold? Sure. But have they been successful in doing that in the past? Not really.
So what you're saying is that the more things change, the more they stay the same?
Yeah, but this time is different.
They say that every time. In the week ahead, investor focus will turn to monetary policy, for obvious reasons. The Fed announces its rate decision on Wednesday afternoon, and we're squarely in the 25 basis point rate cut camp. The combination of the recent inflation figures along with the employment data suggests that it's time for the Fed to finally resume the process of normalization. One of the key messaging challenges that Powell will face is to communicate to the market that the Fed is once again in motion while not necessarily committing to any future rate cuts. Now, clearly, the market will take the upcoming rate cut and simply extrapolate that out to future meetings, but the risk that this presents to Powell is that if he attempts to suggest it will be a meeting-by-meeting decision, the market could simply be underwhelmed by the implied less dovishness than previously assumed. So, as a result, our approach will be a classic buy the run-up and sell the event dynamic, as we struggle to envision that Powell will ultimately outdove the dovish expectations that the market is more likely than not to bring into Wednesday. We also get an update of the Fed's SEP, and in focus will be the beloved dot plot. The 2025 dot in June was published at 3.9%, suggesting only one additional rate cut beyond September's move. In the event that the Fed is biased to go at every meeting, i.e. both October and December of this year, then the 2025 dot should be lowered. There is a notable divergence between the SOFR futures market's terminal assumption of effectively 3% next year for Fed funds and the June SEP, in which the Fed projected Fed funds would end 2026 at 3.6%. Now, we expect that gap will be narrowed. If the Fed's historic behavior is any guide, we're looking for the dot plot to simply be effectively marked to market, which would put downward pressure on the 2026 and presumably 2027 dots. We don't see any compelling reason for the Fed to revisit their long-run dot, which at both March and June was 3.0%. The other major projections, including GDP, core PCE, as well as the unemployment rate, might see some modest revisions, but at the end of the day, we expect that the changes to the dot plot will overshadow any other changes in the SEP. The Fed will also have the benefit of the FOMC statement to provide forward guidance. Now, given that the Fed does tend to be reluctant to commit to any forward path for policy rates, we view the risks skewed towards the Fed attempting to retain flexibility between now and the end of the year, being read by the market as more hawkish, or pushing back against the idea that September marks the resumption of a series of rate cuts as opposed to just a one-off fine-tuning adjustment. There's no major Treasury supply on the calendar, although Tuesday afternoon does see 13 billion 20 years, and we see 19 billion 10-year tips on Thursday. Tuesday morning's release of the retail sales figures for August will be in focus, especially in light of the disappointing August non-farm payrolls print. We have long viewed the resilience of the consumer as in part a function of the wealth effect and the record high equity prices, but also somewhat overdue for a corrective slowdown. August retail sales data could prove particularly relevant in that discussion. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And with NASA's recent announcement of a potential biosignature discovered on Mars, all we can say is that it looks like David Duchovny was right all along, as Fox Mulder, not Hank Moody. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.